Welcome back to the Deep Dive. Today, we are taking a scalpel to the financials of AlTi Global Inc. That's ticker ALTI.
Right.
This is a massive name in the ultra-high net worth wealth management space.
It really is. And their Q3 2025 earnings call, which came after a little bit of a delay.
It did.
It was maybe one of the most polarizing reports we've seen all year. I mean, a total Rorschach test.
A Rorschach test is the perfect way to put it. Management was so explicit, framing this as the cleanup quarter.
Yeah, drawing a line in the sand. That was the phrase they used. But what they actually delivered was, well, a set of results where every single positive data point was just buried.
Buried under a mountain of non-cash charges. You had this solid revenue beat, but then it's completely overshadowed by this gigantic headline-grabbing GAAP loss.
Exactly.
So our mission today is really to act as your translator. We need to parse the truly ugly numbers, the ones that, drove the stock down immediately, and weigh them against management's very confident narrative that the underlying sort of normalized business is actually healthy and growing.
It's the critical question. Is this all just necessary accounting noise from the cleanup, or is there some real structural weakness here?
Are they finally poised to break out, or are the messes of the past still actively dragging them down?
Let's start with the headline snapshot, because this tale of two earnings reports really just perfectly captures the challenge they face.
Okay, let's do the good news first, because there was some.
There was, yeah.
On the revenue side, ALTI looks strong, really strong. Revenue came in at $57.2 million.
Yep, 57.2. And that's up 10% year over year.
A healthy 10%.
Yeah.
And it significantly blew past the street's expectation.
Completely blew past it. The consensus was 51.9 million.
So we're talking about a beat of nearly 10% on the top line. For a fee-based asset manager, that's excellent.
It is. A 10% revenue beat suggests their AUM growth is accelerating, or their realization rates are holding up, or both. This should have been a celebration.
It should have been. But then you look down the income statement, and the party just stops abruptly.
It really does.
Because despite all that top-line momentum, the profitability metrics just collapsed the whole narrative.
They did. Non-GAAP adjusted EPS landed at just 1 cent.
1 cent, missing the consensus of 3 cents. So that's already a disappointment, right? It shows costs are still running hot.
But that wasn't the real shocker. The number that hit the wires and caused that negative reaction in the stock
Was the GAAP loss.
the GAAP loss. Total GAAP loss per share was a whopping negative 89 cents,
Negative 0.89.
which translates to a total GAAP net loss of minus $107 million for the quarter.
That is an astronomical number for a company this size. I mean, if you're a cynical investor, a $107 million loss just screams fundamental failure.
Or unchecked spending.
Exactly. How can management possibly claim this is just accounting noise?
Well, that is the $107 million question, isn't it? And it explains all the market skepticism.
So what's their logic?
Their argument is that the majority of that loss, specifically about $87 million in EBITDA adjustments, were all non-cash items.
All tied to their restructuring.
Exactly. They're basically saying, look, we took all the medicine at once this quarter to guarantee a clean slate moving forward.
Okay, so let's unpack that necessary medicine. What are the biggest components of that $87 million in adjustments?
So the first one is the cleanest, conceptually. It's the international real estate exit.
Right. This has been a drag on them for a while.
A huge drag, a troubled business, a major consumer of management time. They finally wound it down, placed it into administration, and it's now reported as discontinued operations.
So management is promising that the charges from that are now the final cost. They're done with it.
That's the promise, getting rid of that structural drag. The second item is, I think, the most nuanced one, and it's fascinating from an accounting perspective.
Which one is that?
It's the $35 million non-cash impairment on their arbitrage fund.
And this is where it gets confusing, because the fund itself is actually doing well, right?
Yeah.
Up 7.5% year to date.
It is. The strategy is performing. And it's critical for you to understand this distinction. This is purely an accounting mechanism.
Okay.
When they acquired this asset, they created an intangible valuation based on projections, specifically projections of how much new money, new AUM would flow into the fund.
So they expected the assets in the fund to grow by a certain amount.
Exactly. And since the underlying AUM in that strategy had not grown year over year as they initially projected,
Does it matter how well the money performed?
it doesn't matter. GAAP rules required them to write down the carrying value of that intangible asset. So the impairment reflects a failure to hit asset gathering targets, not a problem with the investment strategy.
That's a really key piece of information that just gets lost in the headline loss number.
It does. And the third major item, a $30 million charge for a full valuation allowance against their deferred tax asset, or DTA.
Okay, for anyone who's not a tax specialist, what is a DTA? And why does writing it off create a $30 million loss?
So a DTA is basically a credit for taxes you expect to save in the future, usually because you've had big losses in the past. It's like a prepaid tax benefit.
Got it.
But accounting rules say if a company has substantial losses and there's uncertainty about whether they can generate enough future profit to actually use those tax savings,
They have to write it off.
they have to book what's called a valuation allowance.
Yeah.
So because they just reported that massive $107 million loss, the auditors basically force them to say, we can't guarantee we'll be profitable enough soon to use these.
So it's another non-cash charge.
Yeah.
It's an admission of uncertainty, not cash leaving the business today.
Precisio. And the result of all this radical cleanup is a streamlined structure. They're shifting to a single reporting segment, unifying everything.
Which signals an end to that fragmented, complicated structure of the past. Okay, so that's the mess they cleaned up. But let's set the GAAP noise aside.
Let's do it.
What does management want us to focus on? The underlying core engine of the business.
And that engine is built on a remarkably resilient and sticky client base. When you look at the underlying franchise strength, the metrics are seriously impressive.
Like what?
Assets under management, AUM, hit $49.3 billion. That's up 6% year over year.
Okay.
And assets under advisement, the AUA, jumped dramatically to $89.2 billion. That's a 31% increase.
Wow, 31%. But, for a UHNW manager, it's the quality of that revenue that really matters. How durable is it?
It's extremely durable. They emphasize that 95 to 96% of their revenue is recurring. Management fees, advisory fees.
So it's not transactional. This is sticky, high-quality annuity revenue.
Exactly. And look at the client profile. Retention is around 96%. Average client tenure is 10 years.
And the average AUM per client is huge.
It's above $50 million.
$50 million per client. You're not dealing with small, fickle accounts here. That provides incredible stability.
It does. It means they can focus on integration and cost cutting instead of constantly chasing new money to replace assets walking out the door.
And it positions them to leverage their competitive advantages, like that Allianz joint venture.
The Allianz Private Markets JV is a huge deal.
How so? What does that give them?
It grants them institutional-grade access to private credit, private equity, all sorts of alternatives. For a $50 million client, that's what they demand.
Right. Customized access to non-public markets.
And AlTi acts as the gatekeeper, using Allianz's scale to get preferred access and lower minimums that a smaller firm just couldn't match.
And we're seeing that pay off in their organic growth numbers. They're winning new billable assets.
They really are. $600 million added internationally in Q3 alone. That's $1.2 billion year to date internationally.
Plus another $1.1 billion in the U.S.
Yep. And they're very focused. They're targeting 4 specific segments: women who manage wealth, family offices, endowments and foundations, and what they call established wealth.
It's a much more focused approach than just chasing any rich person who walks in the door.
Right. Which brings us squarely to the execution piece.
The make or break element for the stock price over the next year.
The zero-based budgeting program, the $20 million question.
Exactly. So the core plank of their plan now is proving they can actually get cost savings out of this new streamlined structure.
And the target is big. They're aiming for approximately $20 million in recurring annual gross savings by the end of 2026.
$20 million is huge. For listeners, what exactly is zero-based budgeting?
It's an approach where every line item of the budget starts at zero each year.
So instead of just rolling last year's costs forward,
management has to justify every single dollar of spending from scratch. It forces intense scrutiny on things like technology, professional services, their real estate footprint.
So have they shown any actual evidence that this is working? Or is it still just a promise?
We do have early evidence.
Yeah.
And this is probably the most encouraging operational sign, though it was buried by all the JAP noise.
Okay.
Non-compensation expenses, the exact categories they're targeting, they decreased sequentially by $600,000 from the prior quarter.
That's a tangible reduction.
Yeah.
And that was even while absorbing costs from the Contora acquisition, right?
Correct. If you exclude the Contora costs, the reduction was actually over $1 million sequentially. So the ZBB efforts are already yielding measurable results.
And they're operationalizing this with those centers of excellence.
Right, in Lisbon for international operations and Delaware for the U.S. side.
It's about shifting functions to more cost-effective locations, building an operating leverage so costs don't scale one for one with the business.
It's the necessary evolution from a fragmented group of companies to one coherent global platform.
Okay, so we have strong revenue, a successful cleanup, and early evidence of cost cutting. Why isn't the stock soaring? It has to come down to guidance.
It does. Are they ready to put a hard number on when those $20 million in savings actually translate to EPS?
And the answer is no.
The answer is no. They maintain only a qualitative outlook. They said expenses should trend down and margins should expand over 2025 and 2026.
But they explicitly avoided providing any detailed numeric 2025 EPS guidance.
Which is the entire problem for investors.
So management is asking the market to ignore a massive 9-figure GAAP loss, trust their normalization story, but they're providing no hard goalpost to hold them accountable.
It requires a huge leap of faith. Blind trust, really.
And the market, based on that 4.7% drop in the stock right after the call, is just not willing to grant that trust yet.
Not at all. They're saying, show me the clean quarter, then we'll talk valuation.
Let's put that skepticism in context. How has the stock actually performed?
The performance gap is pretty significant. ALTI is trading around $4 a share. It's down about 16% over the past year.
While the S&P 500 is up.
Up around 13% over the same period. So it's a huge underperformance reflecting that uncertainty.
And what are the analysts who actually cover the stock saying?
Well, coverage is thin, and it's characterized by a reduced consensus. One hold, one sell. That's it.
They're not buying the story yet either.
Not yet. They're flagging the complexity, the earnings volatility, the dilution risk. The narrative has to evolve from complex restructuring story to scaled, predictable UH&W consolidator.
And that shift relies entirely on execution. The catalysts are obvious. Clean quarters, better margins, successful integrations.
If they nail the ZBB execution and that $20 million in savings starts hitting the bottom line, the stock could see a massive inflection point. But until then...
Guilty until proven innocent in the eyes of the market.
Precisely.
All right. That brings us to our final segment. The segment where we dive into a hypothetical trading strategy.
And where we must be very clear.
We must be crystal clear. For the record, this is absolutely not financial advice. We are presenting this as a hypothetical scenario purely for educational and entertainment purposes.
Absolutely. Do not trade based on this concept. Use it to understand the complexity.
Okay, so given the intense near-term noise, the lack of firm guidance, but this very clear long-term cleanup target of 2027, what's your outrageous but plausible trade idea for ALTI?
I like a specific time spread options trade here. The idea is to capitalize on that exact dichotomy, the market's aversion to near-term noise versus the long-term structural cleanup.
Okay, lay out the mechanism for us.
The strategy would be to short the nearest dated call options, let's say the Q1 2026 options.
Why those?
Because you're capitalizing on the immediate execution skepticism. You're betting that they will probably fail to deliver that immediate sequential margin growth the market wants. Near-term volatility keeps those calls relatively expensive, so you can sell them and collect a nice premium.
So you're betting against the immediate rebound. Where do you place the long-term bet?
Simultaneously, you'd buy deep, long-dated call options. I'm thinking Q4 2027 expiration.
And why that date specifically?
Because that's a pure high-leverage bet on two crucial milestones that converge right around then. First, the full implementation of the $20 million ZBB savings.
Which is targeted to conclude in 2026.
Right. And second, the wind down of all the remaining UK real estate financial support obligations, which management stated ends definitively on December 31st, 2027.
So you're essentially betting that the cleanup story actually plays out over the next 2 to 2.5 years.
Exactly. You're betting on that massive inflection point where all the noise finally dissipates, the cost base is reset, and the GAAP losses convert into predictable cash flow positive results.
It's a way to hedge the immediate volatility while placing a long-term bet on the structural thesis. Very interesting.
We're generating premium from the market's anxiety today to fund a bet on their success tomorrow.
Perfect. To wrap all this up, what we've gleaned from this Q3 call is a company that has, at least according to management, finally done the hard, ugly work.
They've exited the non-core businesses, they've absorbed the non-cash impairments, they claim they have finally turned the page.
But their story is one thing. Now the game shifts entirely to execution risk. The clock is ticking on converting that focused platform into actual margin expansion.
That's right. Revenue growth is great, but until those $20 million in savings show up in the form of lower adjusted expenses, that revenue strength just won't translate into investor confidence.
Which leaves us with a final provocative thought for you to consider as you track this stock. What visible, tangible proof point in the upcoming Q4 2025 results, I mean, beyond just more AUM growth, what will the market accept as definitive evidence that the normalized lower operating expense base is truly locked in?
Is it a major sequential drop in that non-comp spend? Is it a measurable uptick in the adjusted EBITDA margin that isn't reliant on one-time items? The market is demanding undeniable, repeatable proof.
Proof that the business is now operating as the streamlined, profitable entity they're capable of being. So think critically about that execution risk versus the significant structural opportunity in the UH&WL space. Thank you for joining us for the deep dive.